Would you say, instead of doing a temporary buy down, would you rather a buyer do a permanent buy down if they wanted to get their rate, let's just pretend, to like a 5.25, pay that money up front now and have that 5.25 for the lifetime of the loan? And if they choose to refinance later on, they do that at that point in time.
Absolutely. I think in general, when I run numbers for my client, let's say that the interest rate is going to be at 6.5%, which is about average for today's conventional mortgage rates. Then with a temporary buy down, if you're doing a 2-1 buy down, then the interest of what the difference would be in the monthly payment down to 5.5% or 4.5% is prepaid into an escrow account. So because the interest rate and the interest paid on that loan is still 6.5%, even if you can get it prepaid from the seller, I'll typically, to answer your question, use that money to do a permanent buy down if they truly need a lower mortgage payment, because that way the mortgage payment is still fixed. If they can't afford that payment on day one, they're not going to be able to afford it in year 2 and in year 3 when the payments adjust. So I feel like those temporary buy downs are a short-term fix for a long-term problem. Whereas a permanent buy down, we have more predictability and stability, especially when inflation is high, for borrowers going down the road. Because we already know that the cost of insurance is going up, we know that property taxes are going up, and the last thing that they want is for the principal and interest payment of their loan to go up 10, 15% per year for the first couple of years.